Okay, the clock on the wall says 2 p.m. Central, and so we will start today's webinar. First, I'd like to welcome everyone to today's webinar, Business Planning to Prepare for FSA Applications. This webinar is part of our Credit and FSA Program webinar series that includes sessions focused on a variety of Farm Service Agency program topics, including business planning, credit repair, financial and marketing risks, youth loans, microloans, and fractionated land loans, and understanding your rights of appeal. If you look at the handout section of your control panel, you'll see a flyer that contains all the information you'll need to join any of the remaining trainings in this series. You'll also find the slideshow being presented today that you can download and keep for later reference. I also invite you to visit our website at indigenousfoodandag.com, where you'll find more information about this series and downloadable copies of the presentations. We will also post and archive videos of each webinar after its conclusion. All attendees will be muted during the presentation. Attendees should use the control panel to raise their hands, or you can submit questions using the questions dialog box. This series is possible with support from the USDA Farm Service Agency and the University of Arkansas School of Law Indigenous Food and Agriculture Initiative, who have joined to offer this important series of webinar trainings. I'd like to introduce today's presenter, Dr. H.L. Goodwin. He is a senior economist with the Indigenous Food and Agriculture Initiative. Dr. Goodwin is a professor and poultry economist at the University of Arkansas in Fayetteville, senior economist at the Indigenous Food and Agriculture Initiative, and director of student networking and curriculum enhancement for Bumpers College. He joined the faculty of the University of Arkansas's Center of Excellence for Poultry Science in Agricultural Economics and Agribusiness in December 1997. Prior to 1997, he was the Agricultural and Food Systems Policy Advisor to the Minister of Agriculture in Slovakia and a Fulbright Scholar in Czechoslovakia. Goodwin was on faculty of the Texas A&M University Department of Agricultural Economics from 1982 to 1995 and served as the Associate Director of the Texas Agriculture Market Research Center from 1989 through 1995. He received his PhD in Agricultural Economics from Oklahoma State University in 1982. HL, the floor is yours.
Thank you, Brian. You can all see this beautiful sky behind us. I wish I could bottle this weather. Mid-30s, no clouds, no wind. It's a fabulous day. I'm excited about this, and I'm glad everyone has joined us. What I hope to do today is give you a little teaser on the kinds of things that you'll be able to experience over the five seminar package. And I want to start out briefly, Brian, by showing them some of the farm loan information that we will be giving them background information with which to apply. So if you could go to the first slide. These are some of the farm loans that are most applicable to the broadest audience that will probably be listening to this, and probably the broadest audience of attendees in the future. You can see them there. I'm not going to go through them in excruciating detail, but I just wanted to give you an idea about the kinds of things that you will be able to apply for if you so choose, if you properly implement some of the steps that we'll go through today and in future seminars or webinars. Go to the next slide, please, Brian. Some more loan information. I just want to stress that a lot of this information is predicated upon being able to demonstrate your record system meets the requirements. And so today's part of this webinar, the introductory part, will be on record-keeping systems and the kinds of information that you'll have to provide FSA with. For example, Brian, if you go to the next slide, these are some of the application forms that will be required for any of these loan packages. There are 9 forms. These are all available on the FSA website. You'll see the form numbers 2001, 2002, 2003, etc. And these particular forms are required, and what we're going to go through today is how to structure the background information that you will need for this. We will not cover today actual business planning per se, the development of a business plan. That will be touched upon to different degrees in later webinars. But I just want to emphasize, if you do not have a business plan, you need one. And there are a lot of good business planning tools that are available online. There's a lot of information from AgPlan. There's information from the Small Business Administration, several sources. We'll go through those a little bit later in subsequent webinars. We will focus on the record-keeping aspect. So let's look first at the purpose, really, of record-keeping. The financial plan. What is your financial plan? What kinds of requirements do you need to have to even begin your business? What have you done in the past? Have you done anything in the past? Is this a new enterprise? We'll go through looking at enterprise analysis, risk assessment, and break-even. All these are particularly important pieces of your financial plan that you'll have to present and formulate in your applications to FSA. So here's sort of a true confession question. You don't have to obviously answer this. We're not going to take roll on this. But is your record-keeping system good, bad, or ugly? When I was growing up on the farm, our record-keeping system was, I'd call it was good and ugly at the same time. By that I mean we threw our receipts in a boot box or in a bottom drawer, and when it came tax time, we got those together for taxation purposes so we could fill out our Schedule F and go on our merry way. What we missed doing that was the ability to actually do individual assessments of our farm production system, because we could not utilize that in an ongoing basis to help us make decisions. We had to go sort of on our gut or what we remembered. And so what I hope to do is entice you today to develop a good record-keeping system so that you use it not only for tax compliance but for better decision making, and obviously to secure adequate capital financing for your operations. What do people think? You know, here we go. The small producers in the red, the larger producers in the blue. Minimal record keeping, ledger system, or computerized. This is a survey that was done in 1998, and we see computer systems. About half of the larger producers at that time were computerized record systems. I would suspect presently of the large producers, it would be at least 3/4 of them using a computerized system. Okay, Brian. So what's the purpose of record keeping? You see here 4 things on this slide here. Most of us don't really think about these 4 things. We pretty much keep records so that we can comply with legal requirements and tax requirements. But very importantly, we can establish and benchmark facts about our businesses. We can incorporate both financial records and, very importantly, production records, particularly if you're going to apply for any kind of government program assistance or crop insurance, livestock insurance. You have to have those production records. It's a measure of your own business performance, and then it also is useful in meeting legal obligations, loan applications. So that's why we keep records. If we don't think we need to play in any of those 4 aspects, if we think as producers that we don't need to know facts about our business, that we don't need to keep track of our business performance, then I would submit to you that maybe you don't need records. However, I don't know anyone that's in that position. Most people are in agricultural production to make money and at least to break even. And if you don't keep records, I would submit to you that you can't do either one of those. So what are our alternatives? We've already seen those. One is computerized. You know, way back when I was in graduate school, I remember getting the first TRS 80, the old Tandy Trash 80. And they actually had the 5 1/4 inch floppy disks, and you had to insert those with your program, take them out, insert your information, take it out, insert the program back, run your project, run your problem, and it was not very powerful. Now we have such fabulous computerized systems, and the software is quite cheap. It's easy to keep. You can generate multiple kinds of reports. So if computers are not your thing, maybe they're your spouse's thing, or maybe they're one of your children's things. But I would say that computerized records are a great asset to us. And but I would also say to keep a backup copy, and you may even want to keep paper records to support those. The other obviously is hand-kept records. You don't have to learn software. It's cheap. But the problem is when you want to sort and summarize these, you have to do them by hand, individually, and there's a great opportunity for error and wrong information. So computerized systems are much more accurate and they're easier to use. One that people use is Quicken, and I'm not advertising Quicken, but it happens to be a popular personal software package. It's inexpensive, it's user-friendly, it's flexible. You can have your own copy that you keep. You could keep it in a cloud. You can join it by subscription. So Quicken is just something that a lot of people use. A lot of your state extension services may have supplementary information on Quicken. So it might be a good place to start if it suits your needs and if you're not already using something else. It has some shortcomings. It wasn't put together for ag producers. It's very cumbersome to keep production records on there. You can't really create a physical data field. You can use memos to comment on that, but it's really cumbersome. It's cash accounting. You can't keep depreciation records in there. And if you happen to be large enough to need payrolling or invoicing features, the basic version won't give you that. However, you can get advanced versions that have that capability. So there are some drawbacks, but you know, it can be adapted and there are ways to utilize it. And they're coming up with upgrades all the time. Here are your basic features: accounts, budgets. You can track loans. You can do tax planning. You can build in reports and graphs, and also do several of the online features that many of us are utilizing today in our record keeping. So what do you need in a record keeping system? You must have an inventory of your assets and liabilities. And we'll get to this in more detail in just a few minutes when we start to look at our balance sheets. You have to have a transaction journal of income and expenses. You need copies of the tax returns that you filed, and you need employment records for yourself if you have off-farm employment, and for those that you employ. So these are financial records that are really absolutely necessary for you to be able to perform up to the expectation of any financial institution when you apply for funding, and certainly FSA is no exception. Here's a little guideline. Many of you may no longer get canceled checks. I know when I get my bank statement, I have scanned copies that they put, I think, 12 per page of the checks. So if you're like me, unless you get out the magnifying glass, you can't really see them. But you do at least have a record. It's recommended to keep those for 6 years. 6 years after the tax deadline for the year of sale, loan agreements should be kept until they're changed or updated. Any large receipt, you should keep that until it's sold or discarded, primarily so that you can show salvage value, and also if it's sold, you can show depreciation and potential capital gains. And of course, your tax returns need to be kept for 6 years as well. So what's the first thing we need to think about with our record keeping system? Many of us have numerous enterprises. We may have, for example, in the Midwest, it was typical for decades to have corn, soybeans, beef cattle or hogs, maybe some dairy, some hay. So you had multiple enterprises. One of the things that we really need to get used to is analyzing our operations on an enterprise by enterprise basis and have those sorted so that you can really do the analysis. I worked in Eastern Europe, as Brian said, and the large collective farms over there many times had 6 or 8 or 10 different enterprises that were involved. And when I went out to work with them, I'd ask them the question, well, do you make money on hogs? Do you make money on potatoes? Do you make money on your dairy? And one farm I went out to, they didn't, you'd ask them all these questions. Do you make money on dairy? No. Do you make money on hogs? No. Do you make money on wheat? Well, not really. And so I asked, and then I said, what do you make money on? Oh, we always make a lot of money on corn. But as I looked at that, they assigned their labor not to the corn enterprise, but to the hog and dairy enterprise. So they had everything all messed up. They really couldn't tell what they were making money in and what they weren't. It's very, very important that we understand what our profit centers are. For instance, the example that's shown there, if we have a lot of forage, we may think, well, we should bale our own hay. It may be better to buy hay than to bale it, or it may be better to bale your hay and sell it and buy other hay, or some combination. So, we can't make these decisions separate from information. We need our records, we need our enterprise analysis to be able to really identify what our profit centers are. A lot of people have trouble calculating cost of production. Back in the day, back in the 80s, there was a lot of cost of production information. It was very, very specific for regions and for particular enterprises that was kept up by USDA Economic Research Service. A lot of extension services keep this information. But as budgets continue to tighten, there's less and less information that you can get from a secondhand source. So I recommend that you keep very, very specific enterprise budgets for all of your work. If you're in cattle production, I suggest having a separate enterprise for cow-calf, a separate for stockers, a separate for breeding bulls. Separate your native and improved pastures, your custom work, any horses that you might use. This is meaningful as you begin to look at insuring through a risk management agency or farm service agency, having disaster insurance, having crop insurance, pasture insurance, livestock insurance. You need these records, and you may as well keep them as separate enterprises and just throwing everything together as a cattle enterprise, because you'll be asked information that's very specific and that you'll need to identify which enterprise it's from. So make certain you allocate both cash and non-cash expenses. Identify cash and non-cash expenses, and make sure you keep track of this. So what's a non-cash expense? Keep track of your time. Keep track of use of equipment that is depreciable. Make sure that you don't underestimate your true cost, because there are always two kinds of costs. There's a cost that shows up on your Schedule F, that's taxable income, but there's also the cost that works out of your cash flow. So you need to keep track of all these things so you'll have an accurate and specific idea of how you should make decisions on what's profitable and what's not. Okay, Brian. Here's just an example of calculating your cost of production. Make certain that you are specific. It's a lot easier to aggregate things than it is to disaggregate them. So keep your cost and your expenses as specifically stated as possible. Match them with your enterprise, and then if you want to combine those to get your more total picture of your profit, you're able to. If you throw everything together, it becomes very difficult. And the examples I have there on types of hay, fertilizer cost, and these kinds of things, tractor expenses, is a good example of that. You may have 2 or 3 different kinds of forage, one that you utilize, one that you sell for profit, and that needs to be accounted for so you can make certain that you do your pricing appropriately for your production when it's possible. Here's some non-cash expenses. We get into things like beginning and ending inventories, prepaid expenses, things, ad valorem taxes, all these kinds of things. And it depends on if you're going on a cash or an accrual system. Many people in farming choose to go on an accrual system, particularly if they've got inventories that they want to manage. And this is necessary to have what items that you actually own and what items you owe for when you have your balance sheet. So these kinds of non-cash expenses are very useful in demonstrating what your true balance sheet is. So let's have a plan. Here's a plan for you. Spend 30 minutes a week maintaining your records. I mean, that's not much. 30 minutes. It will make you feel better. Trust me. I've done it both ways, and it's like the old Fram oil filter commercial. Pay me now or pay me later. If you spend this 30 minutes a week, when it's time to make your monthly decisions, when it's time to make management decisions, when it's time to do your taxes, when it's time to put together your loan applications or your government program applications, you will be happy that you invested 30 minutes a week maintaining your records. And there's no need to try to bite off the whole thing at one time. If your records are not in as good a shape as you would like them, do one thing a month to improve your record keeping system. For example, let's go to the next slide. Here are some things you can do. And I have put these in lists of both financial and emotional importance. Many of us, whether we like it or not, face our own mortality or the mortality of others, and we need to have these things in order. You need a will. You know that 65% of all ag producers don't have the appropriate will and trust documents in place to pass their property in the case of either an expected or an untimely death. The amount of stress that this causes on a family is almost incalculable. So do everyone a favor, please. If you don't have a will, make one. If you don't have a trust, make one. If you have those, make sure they're updated. Situations change. Family dynamics change. Health things change. Have that will and those trust documents and your medical directives up to date. attend that, review it every month. I just can't stress this enough. I've had some situations in the last year that have required my spouse and I to really consider what we want to do. We've both lost parents in the past year. So those medical directives and the trust decisions are very, very important. Know who your life insurance beneficiaries are. Keep them updated. If you have retirement accounts, Social Security accounts, keep those things updated. Have a durable power of attorney in place. And so you may be thinking, well, what's this got to do with record keeping? It has a lot to do with these major legal types of records that you must have in place to ensure timely transition in an easy situation for your heirs and your family members. Keep your farm list assets updated and your household assets. Have a list of your numbers of your various accounts. If you're fortunate enough to have multiple accounts because of FDIC requirements, have those in place somewhere that are easily accessible so that family members can deal with that, and other management that on your operation can also deal with that. Okay, next slide, Brian. Take pictures of these things. Keep them in a safe deposit box or someplace safe. If you have them somewhere else, notify your family members where they are. And then sit back and relax knowing that you're prepared for emergencies. These are just things that you can do to take care of a lot of these items. So here's some references if you want to go through these. These are just some that I'm familiar with. They're all excellent resources. And we see up there at the top, just do it. I mean, this is a place where we can take our Nike slogan and just get after it. So use these resources, and they're all listed here on this webinar. And these webinars will be archived, so you'll be able to go back and refer to this information. Okay, so let's move now to talk about balance sheets and financial statements. This is where the rubber begins to meet the road. You've got to have financial statements, and everybody wants to answer to two questions. How did your operation perform, and where does your operation stand? It's just like anything in life, whether it's financial statement, a baseball or football team, your stock portfolio, how your congressman or senator happens to be doing. These are questions you want to know, and that's what financial statements are for in your record-keeping system. So what's a balance sheet? A balance sheet is just a snapshot at a point in time. At any one date, it's a summary of what you owe versus what you own, and it's an estimate of net worth. You value assets and liabilities by category, and this thing can change daily. I mean, if you've got a stock portfolio, or if you have certain inventories and it's struck by a disaster, your net worth can change very, very quickly. So it needs to be updated and calculated at least yearly, but better yet quarterly. So what's the usefulness of a balance sheet? First thing, it provides us a lot of information for making evaluative decisions. It tells us about our capital structure, rates of returns. It helps you analyze how well your operation is doing in terms of liquidity, solvency, and financial flexibility. And we'll talk about these 3 points as we move ahead to liquidity, solvency, and financial flexibility. But balance sheets have some limitations. One of the things are that most assets and liabilities are stated at historical costs. In other words, what you paid for them, and any depreciation that you may have taken out is not reflected. Judgments and estimates are used in determining a lot of the items. There's no handbook for value of assets. Balance sheet doesn't report items that you can't objectively determine. If you have a certain type of production or product that has a great brand equity, you can't show that in a balance sheet. If you have a great customer base or high credibility, you can't show that. It also doesn't give information on so-called off-balance sheet financing. Any kind of personal information that you may have that's not included in your operation will not show up. So that we got some guidelines for reporting assets and liabilities separately. Let's go through those, Brian. One way you can do it is by type or function of the central operation. For example, we've mentioned hay, forage, and the various functions of a cattle operation. So one way you can do a balance sheet is the expected function in the central operation. Another way is to look for seek implications for financial flexibility. It is good to have a mix of short-term, intermediate term, and long-term assets, because those all imply ability to respond to opportunity or problems as they arise based on liquidity. So liquidity is a big, big part of this whole financial record-keeping system. When we look at assets and liabilities, this is some of the classification I was speaking about earlier. You can see these: current and long-term investment, property, plant, and equipment, intangible assets. Similarly, you've got liabilities and equity that you have there. Many of us probably don't have any owner's equity or capital stock. You don't have probably, if you're in agriculture, you probably don't have retained earnings, but you may have. Okay, let's go to the next slide. So what's an asset? It's something that can be sold to make cash or to make some production. So typically the way these are classified is current, that's anything that can be sold or used within a year, and non-current, which is anything that's not current. In the non-current assets, though, you have intermediate and long-term assets. So let's look at the current assets a little bit more. Anything that you could consume, sell, or convert to cash in 1 year of operation or in an operating cycle is a current asset. And for current assets, you evaluate short-term investments at fair value, and we make a point on this: accounts receivable. Accounts receivable would be if people owe you money, but do it at net realizable value. If you know that you're going to incur a loss from someone, or they can't pay everything in a current period, and you make some other kind of arrangement, or if it's going to cost you a certain amount of money to collect those accounts receivable, you need to reflect that in your current assets. Otherwise, you get a distorted view of what your liquidity really is. Just because somebody owes you something doesn't mean they're necessarily going to pay you in a timely manner. So that's something you really need to consider. What are examples of long-term investments? Stocks and bonds are long-term investments. Fixed assets other than land are long-term investments. Anything you put back in a sinking fund. Wouldn't it be nice if all of us could take the money that we use on our Schedule Fs as depreciation and actually take that out of our cash flow and put it in a sinking fund, so that when it was time to replace equipment or buildings, we could just pay cash for it? Wouldn't that be nice if we were only that fortunate? And then also any other investments that you may have in affiliated companies or anything else. A liability is pretty self-explanatory. It's something you owe to someone else, whether it's interest, whether it's principal, whether it's a bill, whether it's your mortgage payment, payment to an equipment company or a bank for a loan. And again, here we use the 1 year as a current liability and more than 1 year as non-current. So what are some examples? Payables for goods and services, feed, diesel fuel, fertilizer, all kinds of inputs, veterinary service, crop consultancy, anything that is a service, marketing service. Another example would be collections received in advance of service. So what if you're in a situation where you have to pay 50% of the service before the service is provided? That would be an example of a current liability. And then anything else that's paid in the short term, monthly or quarterly payments. Long-term liabilities are those that are in more than 1 year. And you can see a list of those. These are not necessarily applicable to agricultural production unless you are quite large. But if you look at that third one, obligations that are contingent, like product warranties, you may also want to include there any of you that produce and sell food products on a value-added basis. Those have implied product warranties. And I'm not an agricultural lawyer. I'll let others in this series speak to this question. But it could be that you have obligations contingent upon your sale of a product. And those, in fact, if they can be quantified and reasonably estimated with respect to probability of occurrence, it would be wise to have that counted as a liability. Now, what about the intermediate? This is where most agriculturalists operate, is either in current or intermediate assets. If you look at intermediate, it's anything that has a 1 to 10 year life. Essentially, any of your productive assets are intermediate assets. Short-term loans that span more than 1 year. If it's anything but an operating loan that you use during the production in that year, it's an intermediate liability. And the long-term are buildings, lands, and other things that have mortgages. So your equipment, your breeding stock, those kinds of things are intermediate. Your permanent structures, buildings, land, and mortgages are long-term. So now let's get a little bit fuzzy for a moment, and let's look through some things that Farm Service Agency, Farm Credit Service, your local bank, anyone that's going to be involved in the financial aspect of your operation is going to look at these various things. So let's look first at owner equity. That means net worth, essentially. Let's go back a slide here, Brian. Owner equity is essentially your net worth. So if you liquidated whatever you owned, what would be left? Sometimes people say they're upside down in a loan. That means that they owe more than their asset is worth. It's not a good situation to be in. Okay, let's go into the next slide. So how do changes in owner equity occur? Profit or loss if you invest or withdraw capital, or if the values of their assets change. This is particularly the case with land. You remember, some of you that are as gray as I am can remember in the mid-'80s, the farm crisis that we had was driven predominantly by collapsing land prices. And so when your asset value changes and you were collateralized, let's say at 70%, all of a sudden your land is worth half as much and you're upside down in your loan, you are not worth the amount that's required, so you either have to make up that amount or go out of business. If you use cash to purchase inputs or take out a loan to purchase inputs, your equity hasn't changed. Your balance sheet will change, but not your equity. Okay. So here's a little simple equation. Owner equity is assets minus liabilities. Simple. What you're worth is what you own minus what you owe. That is your owner equity. It's not complicated, but as I just said, this asset portion, as value of assets change, either up or down, it changes your owner equity. Value of your liabilities rarely change. It's that asset portion that changes, so we have to keep vigilant when we're looking at our owner assets. What about liquidity? That's the ability to pay debts as they become due without messing up your operation. I mean, you've got to have cash. And for this, you look at current ratio, working capital, and debt structure. These are three things that the banks look at, or that lending agencies look at. If you were thinking about this, ask yourself the question, will I loan money to a person, yes or no? And the answer is predicated on, can they pay me back the loan? If they're illiquid, it makes little sense to make a financial investment because they can't pay you back. And in the final analysis, lending agencies are concerned about your ability to pay back that loan, not necessarily about how wonderful your product is, how tremendous your farm looks, or anything else. They want to answer that question. When I go to my board or my stockholders or my shareholders, can I show that these people that I loan money to pay me back? If they can't, they've made a bad loan. So here's an example of your current ratio. Current assets divided by current liabilities. It's just a tweaking of that owner equity thing. If you have a current ratio of 1, you're okay, but if anything changes, you're in trouble. If it's less than 1, you're illiquid. What does that mean? You've got more liabilities than assets. You're illiquid. Greater than 1 is liquid. Now there's a current ratio greater than 2 that's considered excessively liquid. However, I don't particularly recognize excessive liquidity because that would infer that the producer is making their decisions like a stock company or manufacturing company would be. There, if your capital is not working for you, you're not producing. In an agricultural business, particularly a family-owned business, you probably have other goals like risk aversion, safety from price swings, safety from loss of production, that you may indeed want to be, quote, excessively liquid, unquote. That's a decision that you have to make as a farm operator. But please don't get too excited here. If your current assets are $1 million and you only owe $500,000, you should have a party for you and your family and not be concerned that you need to go out and spend a bunch of money to incur more liability. Working capital, it's not a ratio, it just gives you an idea of how much you could use to purchase inputs. And working capital, a lot of people during the crop season or the production cycle, many people run out of capital, and this is why financial institutions offer operating loans. Some producers don't necessarily like to carry operating loans, but when you're in a business that has lumpy expenditures and lumpy revenues, in other words, you may get paid once or twice a year, it may make a lot of sense to have an operating line of capital or have working capital from an outside source. And those loan payments and interest payments should be viewed upon as a cost of production. Debt structure, it's just how are your debt structured? Are your current liabilities that are due within a year a high percentage of your total liabilities? If they are, that gives you different strategic decisions than if you had a current debt structure where the current liabilities were a very low part of that. So it depends. This gives you an indication of how strategically you want to manage your business based on your debt structure. And you probably should have made those decisions prior to analyzing them. And so the analysis, the debt structure analysis, is just to see if you're on target with how your business is progressing. Solvency. Solvency is a long-term concept. And you know, if you have liabilities that exceed your assets, even in the long term, you're insolvent. No other way to say it. You're out of business. This is the case that I was talking about earlier when land prices collapsed. Many people became insolvent and they had their loans called. They had to go to auction. They did everything they could, but sometimes they just couldn't make it work. What you want to be is in a situation where you are solvent, obviously. So let's look at 3 measures of solvency in the next 3 slides. Your debt to equity ratio, total liabilities divided by owner equity. This is a measure of solvency. If your total liabilities are less than your owner equity, you are solvent. And obviously, the smaller that number, the better. A 0 would be someone with no debt. Wouldn't that be wonderful if we had no debt? I would like to experience that once in my life before I pass on. So that's what the debt equity ratio shows you, or leverage ratio as some people call it. How leveraged are you in your operation? Okay, Brian. Debt to asset ratio is liabilities divided by assets. Again, if your liabilities are less than your assets, you are solvent, and you want a smaller number. You don't want that number to be 1. If it's 1, you have no equity and you are placing yourself and your operation in extreme peril with any kind of uncertainty, any kind of negative outcome. You would become insolvent very quickly. So just to review these ratios, and Brian, if you can just put all these up here at one time and leave them on the screen. These are some things that we've talked about. They're your liquidity ratios that measure short-term ability to pay obligations. Your profitability ratios, that's one we didn't talk about, but that measures your profit based on your expenditures in a year. It's like your profit margin. How effective are you at using the assets that you have? What's your activities? If you're someone who sells out of inventory, your receivables turnover and your inventory turnover are measures of that. And then the coverage ratio is a debt to asset concept, a long-term solvency concept that lets people know long-term what the creditors and investors can have as far as degree of protection. Okay, Brian. Here's some more excellent information. Basic Rules for Financials is a fantastic one. There's an Ag Marketing Resource Center publication that's there. Also a very good extension service publication from Oklahoma State on how to develop a balance sheet. Ag Plan I would direct you to again, and we'll have specific addresses later, but it's agplan.umn.edu, and that should get you to AgPlan. If not, just Google AgPlan, all one word, and you can be introduced to that tool. It's a fabulous tool and very easy to use. So again, just to recap, what we've shared today together is information that will help you be successful in securing and realizing payment of various farm loan products that Farm Service Agency has. And we'll be going through these later in greater detail, but you can see those: direct farm ownership loans, direct down payment farm ownership loans, direct operating loans, and I would point out that for all these you need 3 years of records. So if you're going to go after some of these loans, you've got to start your record keeping before you need it. If you wait until you realize you need the loan, more than likely you will not be successful. There are operating microloans. We have a microloan, a youth loan, and a highly fractionated land loan topic, I believe, set for the, I believe it's the 4th webinar in this series. But there are emergency loans here, conservation loans, all kinds of guaranteed operating loans. These are very, very good programs, but they require filling out of these 9 forms that vary in length from 2 to 8 pages, depending on what they want, what they need. They require farm plans, they require production history, they require financial history, balance sheets, disclosures, a lot of information, but this is what Congress has provided as a requirement for participating in these Farm Service Agency loan programs. Okay, Brian. And again, here's a list of some of these loans, and you can go to those on the Farm Service Agency website and see those specifically. I believe we have concluded the material, and Brian, I'd turn it over to you where we can interact with any questions that have been submitted, and I'll turn the wheel back to you at this time.
All right, thank you, HL. We do have one question that's been submitted, and someone else has their hand raised. One thing that I would like to remind people is if you look in your control panel, you'll see a handouts section. In that handout section, there'll be 2 documents. One is a flyer that has all of the webinars that we'll be doing in this series and where you need to go to register for those webinars. And the other one is today's presentation. So all the slides that HL just shared with you are available in that document. You can grab those documents and actually just drag them over to your desktop, and that way you can have them for your records. So our first question came from Diana, and her question is, what is salvage value?
Okay, what is salvage value? Let's assume that you purchase, I think the easiest way to think about it is purchasing a piece of equipment. Let's assume you buy a tractor for various kinds of maintenance activities around your operation, and let's say it costs $60,000 and has a useful life of 10 years. And you assumed, by useful life, I mean, let's say that's your loan period is 10 years. That means what would you expect that particular piece of equipment to be worth at the end of that loan? And so if you said it would have a 10% salvage value, actually let's make it 20% because the math is easier, then you would have a $10,000 piece of equipment at the end of 10 years, and so your actual cost of that equipment would be 40,000. Your depreciable cost would be 40,000 divided by 10 if you use straight line depreciation. So you'd have 4,000 a year depreciation and a salvage value at the end of that 10-year period of $10,000 if it was 20%. So that in a nutshell is an illustration of what salvage value could be. There might be situations, for instance, with poultry houses, that if somebody says a house has a useful value of 20 years, what is a salvage value? You may conclude that the only thing a poultry barn that is not producing chickens is good for is stacking hay. So you would want to estimate the value of a hay barn of that particular size and use that as your salvage value. So there are a couple of ways, a couple of examples on salvage value.
All right. Just want to remind everyone in attendance that if you have a question for HL, you can either raise your hand by clicking on the little hand logo in your control panel, and I will unmute you so that you can ask your question. Or you can actually type a question into the questions box, and I will read your question aloud. We do have a hand up from Marvin. Marvin, I will go ahead and unmute you. You should be unmuted, so go ahead and ask your question. Marvin, are you there? Okay. He might have hit.
Brian, I want to remind everyone that these webinars will be archived, and at some point later, if you're going through the archive and you have a question, feel free to email me at hlgood.uark.edu, and I'll respond in that manner. If you think of something later, then please submit that, and I'll get back with you.
Yeah, and I'd also point out to folks that the screen that's showing right now, you see that website at the top there, indigenousfoodandag.com. If you go to our website, you'll see a menu at the top right corner of the screen that says training. There's a drop-down menu there, and you'll see this series, the Credit and FSA Program webinar series. If you click on that, it'll take you to a page, and all of the videos of these webinars will be archived there. Right now, I don't see any other questions being submitted. HL, unless you have something else to add, we will go ahead and conclude today's webinar.
No, I just want to thank everyone for their attentiveness. We had a good attendance according to what we see on our webinar screen, and I appreciate that, and I wish all of you a very Merry Christmas season and a Happy New Year, and we will crank up our webinar series again after the first of the year.
All right, thank you, HL. We did have one person requesting your email address again. You can reach HL directly at hlgood@uark.edu.
Thank you, Brian.
And with that, thank you, HL, for the great presentation. And I'll remind everyone one more time to please go to our website, and you can see this webinar again and all the information associated with this series. And we thank you all for attending.
Thank you very much.